The natural rate of interest is zero, by Mathew Forstater and Warren Mosler. Interest rates under a fixed exchange rate regime. While this paper focuses on a floating exchange rate regime, a brief summary of interest rate determination in a fixed exchange rate regime offers context as well as contrast to the prior discussion. Inherent in a fixed exchange rate is the risk of a government's not honoring its legally binding conversion features. Historical examples of this type of default in fixed exchange rate regimes abound, and recent examples include Argentina's and Russia's failing to honor conversion of their currencies into US dollars at their central banks. History is filled with examples of default under various gold standards, with the USA itself technically defaulting in 1934, when it both devalued the US dollar versus gold and permanently suspended domestic convertibility. Bondholders were subject to this default as well, since the US dollars they received at maturity were subject to the new terms and conditions. Market forces translate this default risk into a term structure of interest rates. Default risk is a function of maturity and creditworthiness, with the risk-free rate being the return on holding the object to conversion itself. So in contrast to a floating exchange rate regime, where the term structure of interest rates is necessarily a political decision, generally reserved for the central bank, with a fixed exchange rate regime, the term structure of rates is a function of market forces. In the case of a gold standard, the risk-free rate is negative, as it is the storage charge of holding physical gold. In fact, for all practical purposes, there is no such thing as risk-free, as physical gold can be stolen or otherwise lost, even with the most sophisticated security techniques. In the case of conversion into another government's currency, such as the US dollar, the risk-free rate is the risk-free rate of US dollar deposits, which is the rate on US Treasury securities or deposits at US government-insured institutions. This is the case today in Hong Kong, for example, where the risk-free rate is that of the risk-free rate of the US dollar. With a fixed exchange rate, governments that spend by issuing currency and not borrowing risk having those outstanding units of currency converted to the reserve currency, or gold, as the case may be, at the central bank. Therefore, government borrowing functions to protect central bank reserves and keep the government from defaulting on its legal conversion requirements. Since holders of the currency have the option of conversion to the reserve currency at the central bank, government securities can be thought of as competing with the conversion option, with market forces determining the indifference levels. This explains the very high interest rates paid by governments with perceived default risk in fixed exchange rate regimes, in contrast to the ease a nation such as Japan has in keeping rates at zero in a floating exchange rate regime, despite deficits that would undermine a fixed exchange rate regime. In recent history, today's central bank systems with floating exchange rate policies have followed fixed exchange rate, mostly gold standard, regimes. We suggest that policymakers used interest rate data collected under these fixed exchange rate regimes, as well as their experience of using interest rates for reserve management and macroeconomic policy under fixed exchange rate regimes to guide them after shifting to floating exchange rates. The various correlations between interest rates and economic variables were assumed to continue under the new floating exchange rate regime, including the current notion of real rates versus inflation, and so on. Mainstream analysis of the U.S. twin deficits is but one example of being out of paradigm with respect to exchange rate policy. One reads daily of the USA facing a day of reckoning due to the borrowing from abroad to fund its imports. While this may have had much validity under fixed exchange rate arrangements. With floating exchange rates, a current account deficit is instead the result of non-residents realizing savings desires of U.S. dollar financial assets. There is no funding risk for the USA, nor are U.S. interest rates per se a function of the trade balance.